If I told you a company was managing something like $2.6 trillion, but the average client only had, I don't know, about $5,000 in cash sitting in their account, you would probably think that cash was just a rounding error, right?
Oh, absolutely. Just completely insignificant drop in the ocean.
Right. But if you actually rip apart LPL Financial's Q2 2026 earnings call, which is exactly what we are doing today, you quickly realize that those tiny $5,000 buckets are actually the secret engine.
Yeah, the engine powering one of the most profitable quarters in Wall Street history.
Exactly. So welcome to today's Talk Tickers Deep Dive. We are looking at LPL Financial, ticker symbol LPLA today. And the mission for you, the listener, is simple. We are cutting through all the executive safe harbor statements, all that corporate fluff, to understand the actual nuts and bolts of how a modern wealth management platform makes its money.
And, whether they're setting up retail investors for a massive win or a quiet stall.
Right, because we don't have time to waste today. We are getting straight into the data to see if LPL delivered for its shareholders and what it actually means for your portfolio. So let's just start right out of the gate with the ultimate scorecard.
Yeah. And the scorecard is flashing green in a way we just rarely see in the broker-dealer space. I mean, the adjusted earnings per share, it came in at $5.84 for the second quarter.
$5.84.
Right, $5.84. And, obviously, EPS is the fundamental metric of profitability for a shareholder. It's basically the company's total profit divided by its outstanding shares. But contextualizing that specific number is critical here.
Because it wasn't just a beat.
No, this is not just a solid beat on expectations. It is an all-time record for LPL. I mean, they're squeezing just unprecedented profitability out of their ecosystem. And the sheer scale of that ecosystem is it's what we have to grapple with first.
Let's talk about that scale.
Total client assets have breached $2.6 trillion.
Trillion. With a T.
With a T, which represents a 10% sequential jump from the first quarter.
Okay, hold on. I have to push back on that 10% jump immediately.
Sure, go ahead.
Because we are sitting here in the middle of 2026, right?
Yeah.
The equity markets have been on an absolute tear.
Oh yeah, historic run.
Right, the S&P 500 and the NASDAQ are hitting historic highs week after week after week.
Right.
So if a wealth management firm's assets under management go up 10% in a quarter, where the broader market also goes up 10%, that company didn't actually do anything.
Just floated up with the tide.
Exactly. They just sat there and let the rising tide lift their boat. Passive growth is not a fundamental investment thesis. I mean, how are we verifying that LPL is actually winning new business versus just, riding the coattails of a raging bull market?
That is the perfect question, because that distinction between passive market inflation and active asset gathering is, it's the entire ballgame when you're analyzing wealth management.
Right. So how do they prove it?
Well, management isolates this by reporting what they call organic net new assets, or NNA.
Organic net new assets. Okay.
Yeah. And for Q2, LPL brought in $23 billion in organic NNA.
Wow. $23 billion.
Right. And this metric, it strips out market performance entirely. It's a measurement of the actual physical dollars that newly recruited advisors are transferring over to LPL's platform from competing firms.
That's pure hustle.
Pure hustle minus the capital that leaves the platform, like when clients withdraw funds or if advisors defect. So that $23 billion is fresh capital that simply did not exist in LPL's custody 90 days prior.
That is, that translates to what, like an annualized growth rate of 4%?
Exactly 4%, purely from their own recruitment efforts.
Okay, let's dive into the plumbing of that $23 billion, because moving that much money in 90 days requires a massive logistical machine.
Oh, it's incredibly complex.
Because when an advisor decides to leave a competitor, say like a traditional wirehouse, and join LPL, they don't just push a button and instantly teleport their clients' portfolios over.
Right. If only it were that easy.
It's not. There's the ACCAT system, the automated customer account transfer process. The clients literally have to sign new paperwork. They have to agree to the move. And there is immense friction there.
Tremendous friction.
Every time an advisor moves, they risk losing a portion of their book of business, because clients might just decide, you know what, I'm going to stay put, or I'll just find someone else locally.
Yeah. And that friction is entirely by design. The legacy firms, they want it to be as painful as physically possible for an advisor to leave.
Of course they do.
But despite that, CEO Richard Steinmeier highlighted on the call that advisor movement across the industry has actually normalized back to historical levels after a long period of stagnation.
So people are moving again.
They are. And LPL is essentially acting like a giant net. They are capturing a wildly disproportionate share of these quote-unquote advisors in motion.
I love that phrase, advisors in motion.
It's a great visual. And if we strip out the lumpy, unpredictable institutional deals they sometimes land, because those can skew the numbers. LPL still recruited $25 billion in assets this quarter through their traditional independent channels alone.
Wait, $25 billion just from the independent channels?
Yes. Steinmeier specifically noted this was their strongest recruiting quarter in nearly 2 years.
That is wild. I mean, that implies their value proposition is currently overwhelming the inherent friction of that AC cap process we just talked about.
Exactly. Advisors are looking at the pain of moving and saying, yeah, it's worth it.
But recruiting is only half the equation, right? Because you can pour water into a leaky bucket all day long, but if the holes at the bottom are too big, your total asset base just stagnates.
Well, the bucket at LPL is essentially hermetically sealed.
Really?
Yeah, they reported a 97% asset retention rate over the trailing 12 months.
Wait, 97%?
96.
Keeping 97% of your assets when competing firms are constantly out there dangling, massive multi-million-dollar signing bonuses to poach your top advisors, that kind of defies gravity.
It really does.
You cannot achieve that level of stickiness with just like a friendly customer service desk or a nice annual golf retreat.
No, not at all.
There has to be a structural lock-in happening here. Advisors must feel that leaving LPL would functionally break their business operations.
You're exactly right. You are looking for the moat, and LPL's moat is entirely digital.
Okay, tell me about the digital moat.
So over the last few years, LPL has deployed nearly $2 billion into capital expenditures. And that money is focused almost exclusively on their technology stack.
$2 billion on tech.
Right. The narrative around wealth management companies usually revolves around their investment products or their payout ratios, but LPL is aggressively transforming into a SaaS company.
Like a software as a service company?
Exactly. A SaaS company that just happens to monetize via financial assets. They recently rolled out something called Latitude, which is a unified cloud-based operating system for their advisors.
Okay, Latitude.
But the real catalyst, the thing driving this quarter's massive optimism, is the launch of Cyan.
Cyan. I want to spend some serious time on Cyan because this is where that $2 billion R&D spend actually materializes into operating leverage.
Oh, 100%.
So Cyan is their proprietary AI agent. And usually, when financial firms talk about AI, they mean a glorified chatbot that can look up a stock ticker or reset a password.
Yeah, a slightly smarter help menu.
Right. But reading through the transcript, Cyan appears to be operating on a fundamentally different level. Let's just think about the daily life of a human financial advisor for a second.
Okay.
Their day is completely fractured by mind-numbing administrative maintenance. A client calls and needs to change their primary residence address, update a beneficiary, and increase their monthly withdrawal by $500.
Standard Tuesday morning stuff.
It's exactly.
Yeah.
But in a legacy firm, that advisor or their support staff is logging into 3 different, completely disconnected software environments. They are dealing with 1980s green screens and manually typing that data over and over.
And that manual data entry creates a hard ceiling on how many clients an advisor can physically manage. There are only so many hours in a day.
Right.
Well, Cyan targets that exact bottleneck. It is built on deep natural language processing.
And the green screens.
No menus at all. The advisor does not navigate anything. They just type or speak a command to Cyan. They literally say, update the Smith household address and adjust their withdrawal schedule.
And it just does it.
Cyan executes the API calls to propagate that data across the entire custody, clearing, and reporting ecosystem instantaneously.
That is incredible.
It completely eradicates the operational friction that traditionally forces advisors to hire more and more administrative staff as their book of business grows.
But, the administrative side is really just playing defense, right? It saves time. The offensive capabilities of Cyan are what really caught my attention in this earnings call.
Yeah, the offensive side is where the revenue is.
Management detailed how this AI can ingest a 40-page, highly complex financial plan, something that normally takes a human hours and hours to parse through with a highlighter.
Right.
It extracts the vital insights, and then it cross-references those insights with the broader LPL product ecosystem. The AI then presents the advisor with a prioritized daily dashboard of growth opportunities.
Let us ground that in a concrete scenario so the listener can really grasp this.
Yeah, please.
Suppose an advisor has a client approaching retirement age, but the human advisor hasn't noticed that the client's asset allocation in some external 401k is heavily skewed toward high-risk equities.
Which happens all the time when you're managing 200 households.
All the time. Well, Cyan scans the aggregated data, identifies that misalignment based on the client's stated risk tolerance, and flags it immediately. But it doesn't just flag it. It then drafts a compliant email for the advisor to send, suggesting a meeting to discuss rolling over that 401k into an LPL custodied IRA to better manage the risk.
So it's basically teeing up the sale.
Exactly. Yeah. Cyan is actively surfacing revenue-generating actions that a human advisor would almost certainly overlook just due to volume.
It is essentially an algorithmic business development associate that costs the advisor absolutely nothing.
Nothing but the platform fee they already pay.
Right. I mean, if you are an advisor at a legacy broker-dealer using outdated technology, and you see LPL handing its advisors an AI that automates all the paperwork and tees up rollover opportunities, the decision to migrate your book of business becomes much, much easier.
The tech stack is the recruitment engine. That's the takeaway.
The tech stack is the recruitment engine,
yeah.
But it's also the primary mechanism facilitating LPL's inorganic growth, right?
Yes, the M&A side.
Because we need to dissect the Commonwealth Financial Network acquisition. Absorbing another broker-dealer is historically one of the most perilous maneuvers a wealth management firm can attempt.
Oh, it is a minefield.
Mergers and acquisitions in this space are notorious for blowing up. When one firm buys another, the acquired advisors get incredibly nervous. They hate change. They despise the idea of repapering all their clients to a new custodian.
The paperwork nightmare.
Right. And competitors smell blood in the water instantly. Rival firms will swarm the acquired advisors, offering massive transition packages to defect before the merger even closes.
Yeah, the poaching gets aggressive.
So LPL is targeting the fourth quarter of this year to fully convert all the Commonwealth advisors onto their platform. Where does the asset retention sit right now?
So management disclosed that Commonwealth asset retention is currently hovering in the mid-80s on a percentage basis.
Okay, I can hear a skeptical investor looking at that right now and saying, wait, LPL's normal retention is 97%. If Commonwealth is sitting at 85%, isn't that 15% attrition a massive bleed? Are they losing control of the asset base they literally just paid billions for?
Context is everything in M&A.
Okay, give me the context.
Retaining 85% of assets during the initial shockwave of an acquisition announcement is actually a display of immense strength.
Really? 85 is strong.
Very strong. Because the advisors who leave immediately are usually the ones who were already unhappy with Commonwealth to begin with, or they were being aggressively shopped by competitors before the deal even hit the wire.
That makes sense. There were flight risks anyway.
Exactly. And management stated on the call that they confidently expect to push that retention rate up to 90% by the time the actual systemic conversion happens in Q4.
And why are they so confident?
Because of the technology, again. They are showing the Commonwealth advisors Latitude and Cyan. They're demonstrating that the transition will be digitally seamless rather than a nightmare of manual paperwork. They show them the AI and the advisors decide to stay.
Let us talk about the financial payoff if they actually hit that 90% retention target. What does the Commonwealth deal actually do for LPL's balance sheet once the dust settles?
Well, once the Commonwealth assets are fully integrated and operating on LPL's tech chassis, management is projecting a run rate EBITDA of approximately $435 million from this deal alone.
$435 million?
Yes.
In pure run rate operating cash flow. We are talking about nearly $500 million in fresh earnings power being bolted onto the company.
It's massive.
Which naturally brings up the question of capital allocation, right? What does a management team do when their core business is spitting out record earnings per share and they have an impending massive injection of cash flow from a merger?
Right. What do you do with all that cash?
Exactly. This is where we analyze how LPL is treating you, the retail shareholder.
And they gave us a very clear answer this quarter. During the second quarter, the broader market experienced some volatility, and LPL's stock price took a corresponding hit. In management, using the incredibly sanitized language of earnings calls, referred to this as a, quote, dislocation in our share price.
A dislocation. I love that word. Dislocation is just a polite corporate way of saying the market temporarily lost its mind and priced the stock significantly below its intrinsic value.
Exactly.
Wall Street panicked over some macroeconomic data point and the stock just went on sale. I love analyzing how a C-suite reacts to a sudden drop in their stock.
It tells you everything you need to know about them.
It does. Weak management teams panic, they issue defensive press releases, they try to spin the narrative, or they just freeze entirely.
But LPL's management went on the offensive.
What do they do?
Well, they had initially telegraphed to the market that they planned to repurchase about $125 million of their own stock during the second quarter.
Okay, standard buyback plan.
But when the price dislocated, they dramatically accelerated that timeline. They stepped right into the open market and bought back $309 million in common stock.
$309 million.
Yep. Way up from the planned 125.
This requires a clear explanation of why this is the ultimate shareholder-friendly maneuver. I see so many retail investors completely misunderstand share buybacks. They think it's just Wall Street manipulation.
There's just math.
It is math.
Yeah.
Let's imagine, and I use this analogy all the time because I think it perfectly illustrates the point. Imagine you own a unit in a 10-unit condominium building.
Okay, track it.
You own 10% of the land. The homeowners association suddenly finds itself with a massive surplus of cash in the treasury. They could pay that cash out as a special dividend to everyone, which is taxable and fleeting.
Right.
But instead, they take the cash, buy out one of your neighbors, and literally bulldoze their unit.
A little aggressive, but I like where this is going.
Bear with me. The building still sits on the exact same amount of land. It still generates the same amenities, but now there are only 9 units left in the whole complex.
Right.
You didn't do anything. You didn't spend another dime, but your ownership stake just automatically expanded from 1/10 of the whole property to 1/9. Your slice of the pie got fatter.
And that is the exact mathematical reality of a share retirement. By buying back $309 million worth of stock at a depressed valuation, LPL reduced the total denominator of outstanding shares.
Exactly.
This is why their earnings per share hit that record $5.84. Even if their net income remained perfectly flat, the EPS would rise simply because those earnings are divided among fewer remaining shares.
It is forced value creation.
It forces a compression of the price-to-earnings ratio, which inevitably pulls the stock price upward to correct the imbalance over time. Management saw the market mispricing their equity, and they capitalized on it to permanently enrich the long-term holders.
It is capital allocation executed flawlessly. But, the market is inherently forward-looking. A record Q2 is a nice headline, but institutional money only cares about the trajectory of the rest of 2026 and beyond.
Always asking, what have you done for me lately?
Always. Which brings us to the management guidance portion of the transcript, and specifically, the concept of operating leverage.
Yeah, this was a fascinating part of the call. The Chief Financial Officer, Matthew Audette, provided updated guidance on their core general and administrative expenses.
Right, G&A.
And G&A is the fundamental cost of keeping the lights on, paying the back office staff, compliance officers, technology upkeep, all of that.
And normally in a service business, if your assets under management swell to $2.6 trillion and you are onboarding billions in newly recruited assets, your G&A has to scale proportionally. You need more humans to process the increased volume.
Right. The traditional broker-dealer model is entirely linear. If you add 10% more advisors, you have to lease 10% more office space and hire 10% more compliance officers to review their trades.
Right. The margins don't expand much because costs grow right alongside revenue.
Exactly. But LPL is actively severing that linear relationship. Despite the massive asset growth, management actually revised their full year 2026 core G&A guidance downward.
Wait, downward.
Yes. They lowered the expected range to between $2.14 billion, $2.165 billion.
I have to pause on that because lowering expenses while simultaneously inflating your asset base usually throws up massive red flags for me.
Sure, it sounds like starvation.
Exactly. The immediate assumption is that management is cannibalizing the business to prop up short-term margins. Are they gutting their compliance department? Are they offshoring their customer service so that advisors have to wait on hold for an hour to get basic help? Because if they degrade the service quality, that 97% retention rate we talked about will collapse overnight.
That is the logical fear, but the empirical evidence totally contradicts it.
Really?
Yeah. During the call, CEO Steinmeier referenced the latest J.D. Power rankings for independent advisor satisfaction.
Okay, and how do they do?
while Commonwealth ranked number 1 and LPL ranked number 2.
Wow. And they just bought Commonwealth.
Exactly. You do not dominate third-party satisfaction surveys if you are slashing your service desks. The reduction in G&A guidance is not the result of corner cutting. It is the structural payoff of the AI and tech investments we discussed earlier.
The SaaS transformation in action.
Precisely. Because Cyan is automating the routine maintenance and Latitude is unifying the data flow, the existing back-office staff can handle a significantly higher throughput of operations.
So they don't need to hire proportionally.
Right. LPL can absorb an additional $50 billion in net new assets without needing to hire a proportional army of administrators. The infrastructure is already built. Now they are just running more volume through the pipes.
That is pure operating leverage.
It really is.
And it means every incremental dollar of revenue they bring in falls straight to the bottom line at a much higher margin.
Exactly.
That structural margin expansion is compelling, but, and this is where we really have to get into the weeds. There is another revenue driver buried deep in the technical jargon of this earnings call.
Oh, the cash sweep changes.
Yes. It involved the literal plumbing of the financial system and how LPL makes money on cash. They announced a fundamental change to their cash sweep program, specifically regarding their ICA or insured cash account.
This is vital to understand.
I want to try to break down the mechanics of this, and I need you to correct me if I miss a step here because it gets a little dense.
Go ahead. I'll jump in if you veer off track.
Okay. When a retail client has a portfolio managed by an LPL advisor, there is almost always a small sliver of uninvested cash sitting in the account. Maybe a stock just paid a quarterly dividend, or maybe the advisor sold a position and hasn't redeployed the capital yet.
Right. Cash drag.
That cash doesn't just sit static in a digital ledger doing nothing. LPL aggregates all those small cash buckets across their millions of accounts, and they quote-unquote, sweep them into interest-bearing accounts at partner banks.
Yep. Completely standard industry practice.
And those banks use that massive pool of deposits to fund loans. In return, the partner banks pay LPL a yield based on the current Federal Reserve interest rate environment. LPL then passes a portion of that yield back to the client as interest, and LPL keeps the spread as pure revenue.
Your breakdown of the plumbing is perfectly accurate, and the spread LPL keeps is highly sensitive to how they structure the payouts to the clients.
Okay, so how did they structure it before?
Historically, LPL utilized an asset-based tiering methodology.
Asset-based tiering, what does that mean?
This meant the interest rate a client received on their uninvested cash was determined by the total size of their entire relationship with LPL.
Okay.
So if a client had a $10 million portfolio, they were placed in the highest yield tier, meaning they got a fantastic interest rate on their uninvested cash, even if they only had a few $1,000s actually sitting in cash at that exact moment.
Which is great for the ultra-wealthy client, but it compresses LPL's margin on those specific cash balances.
Exactly, because LPL is paying out a high interest rate on that cash simply because the client has a lot of stock.
Right. So what are they changing?
Starting in August of 2026, LPL is migrating to cash balance-based tiering.
Okay.
The interest rate the client receives will no longer have anything to do with their total portfolio size. It will be dictated strictly by the absolute dollar amount of cash sitting in the sweep account.
Which aligns their pricing structure with how Commonwealth operates, right?
Exactly. And frankly, with the industry standard for independent broker-dealers.
This is where we connect the dots back to my opening hook at the beginning of the show about the $5,000 buckets.
Yeah.
Why does this specific structural change matter so much to the bottom line?
Because CFO Matthew Audette revealed a fascinating data point on the call. The average client account at LPL only holds about $5,000 in uninvested cash.
$5,000.
Yes, and that metric has been stubbornly consistent for over 2 years. Under the new cash balance tiering system, a $5,000 balance falls into the lowest possible interest rate tier.
Wow. So a multimillionaire client who only holds $5,000 in cash is suddenly going to see the interest rate on that specific cash drop because they are no longer being subsidized by their massive equity holdings.
Correct. LPL will be paying out slightly less interest across millions of these small $5,000 cash buckets.
And because they're paying out less, LPL retains a larger portion of the yield provided by the partner banks.
Precisely. Management projects the single pricing adjustment will increase LPL's realized ICA yield by 10 basis points in the third quarter.
10 basis points.
And an additional 10 basis points in the fourth quarter.
Okay, let's quantify a basis point for the listener, just so we're totally clear. 10 basis points is 1/10 of 1%.
Right.
It sounds infinitesimal. It sounds like a rounding error that a lazy accountant would just ignore.
Yeah.
But you have to apply that margin expansion to the sheer scale of the assets we talked about earlier. LPL is currently holding $56.9 billion in total client cash balances.
$56.9 billion.
Squeezing an extra 10 to 20 basis points out of $56 billion translates into tens of millions of dollars in pure, unadulterated, high-margin revenue. And it requires zero additional capital expenditure. It is simply optimizing the pricing architecture.
It is a lever they pulled that instantly creates value.
Just a structural masterclass.
It really is. And as we look at the preliminary data for the current quarter, the structural momentum is holding steady. Management provided a glimpse into July, noting that organic asset growth is tracking right around that resilient 3% annualized mark.
So they aren't slowing down.
Not at all. And total cash balances have stabilized around $54.1 billion. Now, the slight dip from the Q2 number, because it was almost $57 billion, that is a cyclical expected event.
Why is that?
July is the month when LPL deducts quarterly advisory fees directly from client accounts, which naturally draws down the cash balances temporarily.
Oh, right. That makes total sense.
Yeah, so nothing to worry about there. The metrics are solid.
Well, we have dissected a massive amount of corporate data today. I mean, we have looked at the record $5.84 adjusted earnings per share.
A huge number.
We unpack the $23 billion in organic net new assets and the realities of the ACCAT system friction. We explored the $2 billion SaaS transformation driven by Cyan and Latitude.
The AI moat.
The AI moat, exactly.
Yeah.
We discussed the $435 million run rate EBITDA expected from the Commonwealth integration, the mathematical brilliance of the $309 million accelerated share buyback.
Bulldozing the condos. Right.
And the operating leverage created by dropping G&A expenses while optimizing the cash sweep architecture. Now, we have to synthesize all of this into a coherent thesis for you, the retail investor. I am taking a definitive position based on the mechanics we've uncovered in this transcript.
Okay, let's hear it.
The signal emanating from LPL Financial's Q2 earnings is aggressively, undeniably bullish.
I agree completely. The analysis certainly points in that direction. If we distill the bullish thesis down, it really rests on three structurally sound pillars.
Okay, walk us through the pillars.
Pillar one is their ruthless expense discipline in the face of massive growth. The fact that they can scale assets to $2.6 trillion while lowering G&A guidance proves that their $2 billion technology investment wasn't just, a shiny object.
Right.
It fundamentally altered their operating leverage. They have literally broken the linear cost model of wealth management.
Which is incredibly hard to do.
Okay, what's pillar two?
Pillar two is the successful execution of inorganic growth. The Commonwealth integration is tracking exactly as planned. Maintaining mid-80s retention during the absolute most vulnerable phase of a merger with a clear line of sight to 90% shows they know how to onboard massive cohorts of advisors without breaking the culture or the systems.
And unlocking that $435 million in cash flow?
Exactly. That incoming cash flow is going to provide massive optionality for their balance sheet. Right. And pillar three.
Pillar three is capital allocation driven by a management team that aggressively defends its valuation.
The dislocation response.
Right. They do not passively watch their stock price dislocate, they intervene. Accelerating repurchases to $309 million to retire shares at a discount is the hallmark of a C-suite that understands intrinsic value. They act decisively to concentrate ownership for the long-term shareholder.
Which brings us to the actionable advice for you, the listener. If you currently hold LPLA in your portfolio, you need to know that management just authorized a brand new $2.5 billion share repurchase program in July.
$2.5 billion.
Think about the HOA analogy. They have a $2.5 billion war chest, and they are actively going into the open market as we speak to bulldoze outstanding shares and make your specific slice of the company mathematically more valuable. You're holding an asset that is structurally compounding its own value.
It's a great position to be in.
And if you are sitting on the sidelines considering initiating a position, the combination of record earnings, AI-driven operating leverage, and a hyper-aware, shareholder-friendly management team makes LPLA a compelling candidate for long-term compounding.
The financial engineering and the operational metrics are stellar today. I mean, they really are. However, the deep dive into their technology raises a much broader sort of philosophical question about the future of this entire industry.
Oh, I like where this is going.
Management is investing billions into AI, framing tools like Cyan as ultra-efficient assistants that simply remove friction so human advisors can build deeper relationships and gather more assets.
Right. They view AI as a tool that serves the human.
Exactly. But tools evolve. We are looking at an AI that can already read a 40-page financial plan, identify tax inefficiencies, and recommend portfolio reallocation.
Which is mind-blowing.
Right now, it hands that recommendation to a human advisor, who then calls the client and charges a 1% annual fee for the service.
Just to basically relay what the AI told them.
Exactly the point. As AI gets exponentially smarter, as it begins running real-time Monte Carlo simulations, dynamically adjusting risk parameters based on macroeconomic data, and communicating directly through natural language processing, we have to ask a serious question.
Will the client figure it out?
Will the end client eventually realize they are paying 1% for a human to essentially read off an AI-generated dashboard?
Oh.
Will the technology eventually threaten the fundamental fee structure of the human advisor?
That is a terrifying thought for the industry.
Or conversely, will LPL's massive proprietary tech moat make their specific advisors so incredibly effective and hyper-personalized that they become utterly irreplaceable to the high net worth client?
That is the multi-trillion-dollar tension at the heart of modern wealth management. Does the AI remain the invisible assistant, or does it inevitably become the advisor?
It's a structural shift we will definitely be tracking closely over the next decade.
We absolutely will. But for Q2 of 2026, LPL has engineered a quarter of just dominant execution. We hope this deep dive gave you the exact mechanisms and data you need to navigate the corporate muddy waters of this earnings call.
Stay informed and stay curious.
And keep a relentless eye on the numbers. Thanks for joining us.